morning, students. Today we are going to know the another concept. It is a non-banking institutions. And that first we are going to learn about the mutual funds. So this is the graphical representation which is related to the mutual funds. How the investors invest their money into the mutual funds. So here we observe about the investor and they push money with the fund house and the fund managers invest into the securities which is based on the common financial goals and this generates the returns and it is given to the investor back as an interest or yield. So how do mutual funds work? What are their mechanism to work? So investors pool their money in a fund. That means different type of peoples and all together they invest money in the form of a pool that we call it the fund. And this fund, the fund manager, that we call it a professional manager, invests in a diverse set of securities. Again, in financial specialization, we have another subject is security analysis and portfolio management. So here, diverse set of securities means portfolio management. Different type of portfolios the fund manager can invest this fund, and the investment gives the returns, which we call about the generated. It may be gains or it may be losses, or shared by the investors. So in India, the Unit Trust of India, or the short form we call as a UTI, was established on the 1st February 1964 under the Unit Trust of India Act 1963 by the Government of India. Its establishment has been a landmark in the history of investment trusts in India. The UTA started the sale of units to the public from the July 1964. So what is the mission? To make UTA mutual fund the most trusted brand admired by all stakeholders. Why? Because it is backed by the government, the largest and most efficient money manager with global presence, the best in class customer service provider, the most preferred employer also, the most innovative and best wealth creator in the time, a socially responsible organization known for best corporate governance in the time of 1960s. Now we learn about the corporate governance, but this will happen in the years 1960s or 70s. It's related to the Unit Trust of India. So what are the objectives behind to establish UTI? The basic objective of the UTI is to offer both small and large investors the means of acquiring shares in the widening prosperity which resulting from the steady industrial growth of the country. So there is the two primary objectives of UTI. First one, to promote and pool the small savings from the lower and middle income people who cannot direct access to the stock exchanges. Second one, to give them an opportunity to share the benefits at the same time the fruits of prosperity which resulting from the rapid industrialization in India. The functions of UTA. Here we discuss only the main functions. The first one is to encourage savings of lower and middle class people, to sell units to investors in different parts of the country, to convert the small savings into the industrial finance, to give them an opportunity to share the benefits and fruits of the industrialization in the country, to provide the liquidity in the form of units. So here we are going to review regarding the progress which we call it the operations. So the UTA has made good progress during the last 50 years. The bulk of the resources mobilized by the UTI have been deployed in the corporate sector. The UTI gives preference to the securities of new companies as to its investments, as well as UTI invests its funds into the government securities also. What is the mechanism of the sanction and disbursement of loans by the UTI? There is a total investments of UTI until 30th June 1998 stood 59,600 crores, and coming to the financial year 1997 to 98, the UTI collected a record sum of rupees 13.700 crores, sorry, 13,700 crores in its various schemes as against the 9,800 crores in the year 1996 and 1997. The most popular schemes of UTI is Unit 64, which is under UTI added a record sum of rupees 3,170 crores against the 2,600 crores coming to 1996 to 1997. The rate of dividend under this scheme in the year 97 to 98 was 20%. The income from dividends in the hands of investors is totally exempted from the income tax. Despite being the trendsetter in the segment, the UK mutual fund could not sustain the initial tempo and was on the verge of the collapse in the year 2001 before the government bailed it out and restructured the fund. So, fearing a run on the institution and a possible impact on the whole market, the government came out with a risk package and change of management in the year 2001. Subsequently, the UTA Act was repealed and the institution was divided into the two parts. UTA Mutual Fund was created as a semi-registered fund like any other mutual fund. The assets and liabilities of the schemes where government had to come out with a bailout package were taken over directly by the government in a new entity called as Specified Undertaking of UTI. So in order to distance government from running a mutual fund, the ownership was transferred to four institutions, which is namely SBI Mutual Funds, LIC, Bank of Baroda, and Punjab National Bank, which is owing 25% equally. So certain reforms like improving the salary from public sector units levels and effecting a VRS, that means voluntary retirement scheme, were carried out. UTI it lost its market dominance rapidly by the end of 2005. When the new shareholders actually paid the consideration money to government, its market share had come down to closely 10% only. A new board was constituted and a new management inducted. So systematic study of its problems, role and functions were carried out with the help of a reputed international consultant. The fresh talent was recruited from the private market. Organization structure was changed to focus on newly emerging investors and distributor groups and massive changes in investor services as well as funds management carried out. So once again, sorry, once again, UTA has emerged as a serious player in the industry. Some of the funds have won famous awards, including the Best Infra Fund globally from Lipper. UTA has been able to benchmark its employee compensation to the best in the market, which has introduced the performance-related payouts and ESOPs. For its international operations, UTA has set up its 100% subsidiary, that is UTI International Limited, which have the branches in the London, Dubai, as well as Bahrain. It has set up a joint venture with the Shinsei Bank in Singapore. The JV joint venture has got its license and has started its operations. In the area of alternate assets, UTA has 100% subsidiary called UTA Ventures, which is located into the Bangalore. This company runs two successful funds with the large international investors being active participants. UTI has also launched a private equity infrastructure fund along with HSH Nord Bank of Germany and Shinsei Bank of Japan. So this is the introduction which related to the UTI Trust of India. Now we are going to observe the concept which related to the mutual funds. So the concept is called mutual funds started by UTI in the year 1963, which related to RBI. However, it was only in the year 1993 that the industry got a full-time regulator in SEBI and was allowed the entry of private and foreign participants. Comprehensive regulations for the industry followed soon, and the year 1996 saw the notification of SEBI mutual fund regulations. That means the regulations which is related to mutual funds. Since then, the mutual fund industry in India has grown dimensionally and directionally and has debatably seen an elaborate and prolonged regulatory effect among all the segments of the Indian financial markets. SEBI has played a crucial role in shaping the industry and making it more disciplined, accountable, and confident, and so has the Association of Mutual Funds India as industry body. The total assets under management for the Indian mutual fund industry grew to approximately $120 billion at the end of September 2007. Now it may be double. So these are the some of the graphical representation which related to the what are the assets under management by the mutual funds. So here you can observe in the year 1965 UTI at the time there is around 25,000 crores like here crores these are. So coming to the September 2004 it will reach to the 1,53,108 crores. Now almost it's double. So these are the growth, and you can observe there is a different type of phases are there. So the first 18 years we can consider as a phase 1, next 7 years we can consider as a phase 2, next almost 10 years we can consider as a phase 4, and later we can consider as a phase 5. So many reforms have taken place since then. Those are comprehensive disclosure standards for new and existing fund offerings, permitting Indian mutual funds to invest abroad also, allowing non-resident Indians to invest in mutual fund schemes in India, permission for investment in derivative products. The origin of mutual fund industry in India is with the introduction of the concept of mutual fund UTI in the year 1963. Already just now we know that through the growth was slow, but it accelerated from the year 1987 when non-UTI players entered into the industry. In the past decade, Indian mutual fund industry has seen dramatic improvements both quality as well as quantity wise. Before the monopoly of the market had seen an ending phase, the asset under management was $67 billion. The private sector entry to the fund rose the asset under management is to $470 billion in the March 1993, and coming to the in the April 2004 it reached to the $1,540 billion. Putting the assets under management of the Indian mutual funds industry into comparison, the total of it is less than the deposits of SBI alone. So it constitutes less than 11% of the total deposits which is held by the Indian banking. The main reason of its poor growth is that the mutual fund industry in India is new in the country. Large sections of Indian investors are yet to be intellectual with the concept. Hence, it is the prime responsibility of all mutual fund companies to market the product correctly. The primary objective at the time was to attract the small investors, and it was made possible through the collective efforts of the Government of India as well as Reserve Bank of India. The history of mutual fund industry in India can be better understood divided into the following phases. Phase 1, establishment and growth of Unit Trust of India, and it constitutes the duration from 1964 to 87. Unit Trust of India enjoyed complete monopoly when it was established in the year 1963 by an act of Parliament. UTI was set up by RBI and will continue to operate under the regulatory control of RBI until 1970 Act, and then its control was transferred to Industrial Development Bank of India. UTI launched its first scheme in the year 1964 named Unit Scheme US64, which attracted a large number of investors. As well as UTI launched more innovative schemes in between 1970 to 1980 to suit the needs of different investors. And it launched its first ULIP, Unit Linked Investment Policy, in 1971 and introduced the six more schemes between 1981 to 84. So phase 2, it is called as the entry of public sector funds between the 1987 to 1993. The Indian mutual fund industry witnessed a number of public sector players which will enter into the market in the year 1987. So first one is the SBI mutual fund from the State Bank of India, as well as later Canara Bank, LIC Mutual Fund, Indian Bank, Bank of India, General Insurance Corporation, and Punjab National Bank also entered into the mutual fund sector. By the end of the 1993, the asset under management of the industry, which is included seven times, and however, till second phase two, the UK remained to the leader with about the 18 percentage of market share. Phase 3, emergence of private sector funds. In the phase 2, public sector entered into the market. Coming to the phase 3, private sector also entered into the market. The permission given to the private sector funds, which including the foreign fund management companies, to enter the mutual fund industry in the year 1993, which provide a wide range of choices to investors and more competition in the industry. Private fund introduced the innovative products, investment techniques, and investor servicing technology. So by the end of 1994 to 95, there is a 11 private sector funds available in the markets. Phase 4, there's the growth as well as the SEBI regulations, the duration between the 1996 to 2004. Here the mutual fund industry witnessed the robust growth and stricter regulation from the SEBI, and the mobilization of funds and the number of players operating in the industry reached new heights as investors started showing more interest into the mutual funds. Investor interests were safeguarded by the SEBI and government, which offered the tax benefits to the investor. So SEBI mutual fund regulations was released in the year 1996, and they set one uniform standards for all mutual funds in India. The union budget in 1999 exempted all dividend incomes in the hand of investors from income tax. So phase 5, which we call about the growth as well as the consolidation, which coming from the 2004 to nowadays. So this is the information which related to the mutual funds.